We're joined by David Forrester. David is currency strategist at Macquarie Bank. David, thank you very much indeed for joining us. First of all, we've got equity markets today getting a bit of a hit from reports that China is not planning a large-scale stimulus package. How's that making itself felt when it comes to currencies?
Thanks for having me on the show today. I think the most obvious impact is on the Aussie. The markets were a little bit effervescent, I guess, ahead of the announcement of any stimulus package, and there were hopes of sort of 2009-style stimulus package, but the Chinese have clearly gone out there to manage market expectations, so that's weighed a little bit on Aussie and general market sentiment.
But it's all about, again, Europe once more, isn't it? And how much is being priced into these foreign exchanges right now?
I think one of the most curious things about overnight price action was that we've seen the euro-dollar come off, but it's not done that well against the crosses in general. Aussie wasn't dragged a lot lower, Kiwi, for example, wasn't. So it is becoming a little bit more of a euro isolation story. I suggest that the market probably hasn't priced in or is lessening its pricing in of a euro implosion and focusing a little bit more on Spain than the Greek elections at the moment and, of course, the Spanish bank problems.
Well, absolutely, but I mean, what I'm saying is what do we actually price in when it comes to the euro, because I think you've got a target of 128 for it at year's end, but that's before we go down and visit 120. Is it possible that it could even go lower than that?
I think it can get down towards 120. Let's not get too exaggerative here. Let's remember that IMM positioning data, for example, shows that we have record euro-dollar short positions on at the moment. The market is extremely long the US dollar, and we're going to go into a zone next week where we don't get any opinion polls out of Greece ahead of the election. So yes, things can get worse, and so often with the euro-dollar and these periods of crisis, things do get worse before they get better. At the end of the day, we think that Greece probably will stay in the eurozone. It's too expensive for both Greeks and the rest of the eurozone for Greece to leave, and we think rational thinking will prevail at the end of the day. And so euro to visit lower, but at the end of the day, we think it'll go higher again once Greece gets its package renegotiated and stays in the euro.
Let's talk a little bit about the data of this morning, and we had retail sales out of Australia. They disappointed, showed a fall, actually. We were looking for just a slight uplift here. Now, how would you describe what's happening with the Aussie dollar? And again, we're below parity. How much further down do we go? And, or maybe we go up from here, I don't know.
Well, we've got three things weighing on the Aussie. Of course, we've got concerns about Chinese growth and the lack of stimulus at the moment. We've got Europe weighing on Aussie and the general systemic risk that creates, and also the wash-on effects from Europe to China, because Europe is China's largest export destination. And then you have the RBA rate cuts, which are pretty heavily priced in. Now let's get to the RBA rate cuts front. Now the market is aggressively priced at the moment. We do think the RBA could wait in June, because it can wait until after the Greek election before it has to start cutting rates if there is a systemic risk out there. Now, this morning's data in retail sales land, I don't think it adds much in terms of a case for a rate cut. Retail sales on a trend basis are running at 0.3% month on month. Yes, that's a little bit soft, but at the end of the day, households are repairing their balance sheets, and as you pointed out earlier, we need to see some adjustments in Australia. Retail rents are still very high, so we need to see that sort of structural adjustment in Australia. And if the RBA comes in and starts cutting rates hell for leather and bails out retailers, we're not going to see that structural adjustment. So that's another reason for the RBA to perhaps be dribbling out the RBA rate cuts instead of just going hell for leather like the market has priced in.
Where did we go? I had a guess saying that we could hit 85 US cents against the Aussie dollar. What about your view on this?
Well, we're placing fair value with the Aussie, taking into the terms of trade, relative current account balances, demand for Aussie bonds, Aussie government bonds that is. It's in the low 90s, so we think 85 is a bit of a stretch. But we have to remember at the end of the day, we've got still the Bank of Japan and the Fed both threatening further stimulus. So we think 96, 95 is a good buy zone for the Aussie. What we prefer to buy it against, however, is a basket of European currencies as well as the yen. That diversifies the risk of Aussie a little bit away from risk-on, risk-off trading due to euro-dollar. So that's our preferred trade at the moment, waiting to buy that Aussie, and that will be on an announcement of a proper official China stimulus package.
David, thank you very much for your time. David Forrester.